Today, we're going to dive into the world of advanced candlestick patterns in Forex trading. Candlestick patterns are a popular tool used by traders to analyze price movements and make informed decisions. These patterns can provide valuable insights into market sentiment and potential future price movements. By familiarizing yourself with these advanced candlestick patterns and incorporating them into your trading strategy, you can improve your ability to identify potential trading opportunities and make more informed decisions in the Forex market. So keep an eye out for these patterns in your charts and see how they can help you become a more successful trader. So let's start. Advanced Patterns. Pattern number 1, Morningstar Pattern. The Morningstar pattern is a 3-candle pattern that indicates a bullish price reversal. The first candle is a strong red candle with a big enough body. The second candle is a doji or pin bar candle with a small body and large wicks. The doji or the pin bar can be red or green. Then finally we have a big green candle that breaks above the high of the doji candle. The size of this candle will determine the strength of the pattern. If the candle is as big as the red candle, then it is a good trade opportunity. If it is smaller than the red candle, it is a low probability trade. Lastly, if the green candle closes above the high of the red candle, it is a strong reversal candle. The psychology behind the pattern is pretty simple. First, we have a red candle. This shows us that the sellers were in complete control of the markets. They pushed the prices downwards. Then we see a small doji candle. It shows us that buyers have stepped in and are pushing the prices upwards. Soon the sellers lose their strength and the buyers take the prices higher, creating this green candle. It shows that the buyers have turned around the situation and are now likely to see an up move to enter the trade. We will place a buy order above the high of the green candle. We will keep our stop loss below the doji candle. Pattern number 2, Evening Star Pattern. The Evening Star Pattern is the complete opposite of the Morning Star Pattern. Here we have a 3-candle pattern where the first candle is a green candle with a considerably big body. Then we have a small doji candle with a very small body. And finally we have a red candle with a big body. The psychology behind this pattern shows us that initially the buyers were in control as they created this green candle. Then soon enough, the sellers entered and started to challenge the buyers. As a result, we see this doji candle. The doji candle indicates that the buyers and sellers are in a tug of war. Then finally the sellers win the battle and they start to move the price down to enter a sell trade. Here, we place a sell trade below the low of this candle and keep our stop loss above the doji candle. So these were the advanced candlestick patterns that can help you spot trade opportunities. But we are not done yet. We will now understand how to use price action concepts to find entries using these patterns. We will use support and resistance levels and trend lines to combine the candlestick patterns with price action. Here is an example. The price was in a downtrend, but it found support near this area. We see 2 reversals here and mark it as a support level. Then the third time, when the price arrives near the support, we expect it to find support. But we are waiting for a candlestick confirmation on the down move. Here we see that as the price approached the support, the candles became smaller in size. This was the first sign that the sellers were losing momentum. Then we see this doji candle form at the support. Another sign of support. The doji is followed by a large green candle, indicating that the buyers had taken over the control and were ready to move the price. The green candle completed a morning star pattern. It was a strong pattern because the green candle broke above the high of the doji candle and the red candle before it. So a buy trade can be placed above the high of the green candle. We can place our stop loss below the pin bar, and we can target this high. As you can see, the price moved up after our entry. Even if you missed the entry, the price also gave us a second entry. The price made these two tops, creating a solid trend line. When the price reaches near the trend line again, we wait to see if the price develops some pattern. This red candle indicates that the sellers were trying to provide resistance at the trend line. The candle is followed by a large green candle that completely engulfs the red candle. It's a bullish engulfing candle. The low of the green candle is lower than the red candle. The high is higher than the red candle. Again, a very strong indication that the buyers have taken control and the trend line is not strong anymore. A buy trade could be initiated here as well. We place a buy order above the high of the candle, and we put a stop loss below the candle. Our targets will be these highs. As you can see, the price achieved our targets on this trade. Here is an example of a sell trade. Here we see that the price finds resistance around this area. Then, when the price tests this resistance the second time, we see it create an evening star pattern. We have a green candle, a doji, followed by a large red candle. The red candle is so large that it closes way beyond the lows of the previous two candles. Hence, it is a high probability pattern. So we place a sell trade at this candle's low and set our stop loss above the high for our targets. We can target these two lows, and as you can see, the price achieved our targets. I hope you have now understood how to use these candlesticks for your trading again. The candlesticks alone are nothing. You need to combine them with other factors to create a trading system. Thank you for watching. Don't forget to subscribe to this channel if you haven't. Like this video as well. See you in my next video.